What if I told you that some e-commerce categories see return rates 6 times higher than others, and most sellers pick the wrong category without ever knowing it? Returns are one of the biggest silent profit killers in online retail, and the difference between a 4% return rate and a 25% return rate can literally make or break your business. Hey everyone, I'm June with Branvas, and today we're breaking down e-commerce return rates by category so you can see exactly where the money leaks are, what the latest data says heading into 2026, and how to pick and optimize a product category that actually protects your margins. Stick with me on this one. So, let's start with the big question. Why do return rates swing so wildly from one product category to another? And the answer isn't just some products are better than others. It's structural. Think about it. When you buy a shirt online, medium means something totally different from brand to brand. That's fit ambiguity, and it leads to something called bracketing, where customers buy 2 or 3 sizes, knowing they're going to send back the ones that don't work. Apparel and footwear get crushed by this. Then there's the sensory gap. Products like fragrance, cosmetics, and home decor rely on how things look and feel in person. When the real thing doesn't match the photo or the description, back it goes. Electronics have their own issue, compatibility, and spec confusion. It's not that the product is broken. The customer just didn't realize it wouldn't work with their setup. And then there's plain old buyer's remorse. Impulse purchases get returned at way higher rates than carefully considered ones. Once the excitement wears off, people second-guess themselves. Now here's the thing. A high return rate doesn't always mean your product is bad. Research actually shows that generous return policies can increase purchase rates more than they increase actual returns. The psychological safety of knowing you can return something makes people buy more confidently. In apparel, the conversion lift from an easy return policy often outweighs the cost. But in a category like furniture, where shipping a sofa back costs a fortune, that math flips fast. All right, now let's get into the actual numbers, because knowing whether your return rate is good or bad means nothing without context. Heading into 2026, here's what the data looks like across major e-commerce categories. Apparel and clothing sits right around 25%, where 1 in 4 items comes back. Footwear is at about 17%. Electronics are lower at 11%. Furniture and home decor is around 19%. Beauty and personal care comes in at 12%. Sporting goods range anywhere from 10 to 18%, depending on the subcategory. Books and media hold steady at about 9%. Health and wellness is around 7%. And toys and games sit at roughly 10%. Now here's where it gets really interesting. Jewelry and accessories, specifically private label jewelry sold through Branvas, benchmarks at around 4%. Compare that to the mass market jewelry average, which is closer to 12 or 13%. That's a massive difference, and it comes down to curated catalogs and accurate product imagery that close the gap between what the customer expects and what they actually receive. The pattern is clear. Categories that require precise physical fit or rely on subjective sensory evaluation, like apparel and shoes, see return rates double or triple those of more straightforward categories. If you're choosing what to sell online, this data should be a major factor in your decision. Selling in a low return category gives you a structural margin advantage from day one. Okay, so you might be wondering, how does Branvas actually get those numbers? Let me walk you through the methodology because it matters. Branvas measures return rate data across tens of thousands of orders annually from our brand partners. The formula is simple. Units returned divided by units shipped, times 100, measured over a trailing 12-month period. And importantly, damaged in transit claims are excluded. We're isolating buyer-initiated returns only, which gives a much cleaner picture. So what drives that low jewelry return rate? It comes down to 4 things. A curated catalog where every SKU is vetted, accurate macro photography and video so customers see exactly what they're getting, detailed size guides, and a branded unboxing experience that actually reduces buyers' remorse. When your customer opens a beautifully packaged box, there's an emotional moment that says, "I'm keeping this." Branvas actually formalized this into something called the Return Risk Index, the RRI. It's a 4-factor scoring model that predicts return risk for any product before it even launches. The 4 factors are fit ambiguity, sensory gap, expectation alignment, and impulse purchase likelihood, each scored 1 to 5. Here's a quick example. A gold pendant necklace scores a 30 on the RRI, low risk. There's no complex sizing, the photography can fully convey the product, and expectations are easy to set. A men's formal blazer, that scores a 60, moderate to high risk. Because fit is everything, and it's nearly impossible to convey how it'll actually feel on someone's body through a screen. The takeaway is that if you're selling products that naturally score low on return risk, you're playing the game on easy mode. Let's zoom out and look at the bigger picture, because the e-commerce return landscape has changed a lot in just a few years. Return rates essentially doubled between 2019 and 2021 during the pandemic shopping surge, and they've since settled at a new, higher baseline. The overall e-commerce return rate hit about 17% in 2024 and is projected to approach 19 to 20% by 2025 and into 2026. But here's what's really alarming: return fraud. Fraudulent returns, including things like wardrobing where someone wears an outfit once and sends it back, cost retailers over $100 billion in 2024. That's about 15% of all retail returns. Clothing is the most commonly abused category. Retailers are fighting back. 72% of U.S. retailers now charge return fees, and over half of them report that it's reduced their return volume. But there's a trade-off. Adding friction to returns can hurt your conversion rate, so it's a balancing act. On the tech side, AI-driven sizing tools are making a real dent. Brands like ASOS have reported a measurable reduction in returns after implementing AI virtual try-on features that help eliminate size uncertainty before the purchase happens. The macro trend: return rates are stabilizing at a high level, but the cost of processing each return keeps climbing. That's forcing every brand to either optimize their reverse logistics or smarter move. Sell in categories where returns are structurally lower to begin with. Okay, so here's where it gets real, because return rates are only half the story. What actually matters is what each return costs you. When you add up reverse shipping, restocking labor, inventory depreciation, customer service time, and the lost margin from reselling at a discount, a single returned item costs somewhere between $17 and $29. And that's on the conservative side. Let me put that in perspective. Say you're doing $10 million in annual revenue with a $75 average order value. A 5 percentage point difference in your return rate, going from 25% down to 20%, represents over 6,600 fewer returns. At $20 per return, that's $132,000 in direct processing costs you just saved, and that's before you account for items that can't be resold at full price. This is why I keep saying that category selection matters just as much as your marketing strategy when it comes to e-commerce profitability. You can run the best ads in the world, but if a quarter of your orders are coming back, you're bleeding money. Selling in a category with structurally lower return rates, like private label jewelry, protects your bottom line in a way that no amount of marketing optimization can replicate. All right, so let's talk about what you can actually do to bring your return rate down, because the tactics depend entirely on what you are selling. If you're in apparel or footwear, your enemy is fit ambiguity. Invest in virtual try-on tools and AI sizing technology. Create detailed fit guides using real model measurements, not just generic small, medium, large labels. And leverage customer reviews to flag whether items run small, run large, or are true to size. That kind of social proof does a lot of heavy lifting. If you're selling electronics, the key is preventing compatibility confusion before the purchase. Build out your product detail pages with clear compatibility charts, detailed spec sheets, and video demos. Include unboxing guides and set up FAQs so customers aren't returning items just because they couldn't figure out the setup. And if you're in jewelry and accessories, this is where it gets exciting. Your goal is to close the sensory gap. Use macro photography and video that show scale, clasp details, and finish quality. Provide accurate material descriptions and printable ring sizing charts. And invest in a branded unboxing experience that creates an emotional, "I love this" moment the second someone opens the package. If you're thinking about starting a jewelry brand and you want return rates that benchmark against the best in the industry, Branvas structures its entire catalog and fulfillment process around exactly this. It's worth checking out. If you're ready to start a jewelry brand with industry-low return rates built in, head to branvas.com. The link's in the description. You'll get a curated product catalog, branded packaging, and blind fulfillment, so your customers get an experience that makes them want to keep what they ordered. Drop a comment below and tell me, what's the return rate in your current category, and has it been eating into your profits? I'd love to hear from you. Make sure to like this video, subscribe to the channel, and I'll see you in the next one. I'm June. Take care.